Basics of Investing. Chapter 13, Case Studies in Playbooks. Section 1. Bull Markets. A bull market is not just a quick bounce after prices have fallen. It is a sustained period where prices keep rising over time, often enough that people use a rough rule of thumb like 20% or more above a recent low. But that percentage by itself is not the whole story. What really matters is that confidence starts improving. Buyers show up across many parts of the market, and the advance has enough durability to keep going through normal pauses. In stronger bull markets, the move is supported by better business conditions, healthier earnings, or improving economic expectations. So when you hear the term bull market, think broad strength, persistence, and a real shift in trend rather than a brief relief rally. On a chart, a bull market usually leaves a recognizable footprint. Prices tend to make higher highs and higher lows, which tells you that buyers are willing to step in at progressively higher levels. That pattern is important because it shows demand is not disappearing after each rally. In many healthy uptrends, price also stays above a long-term reference, like the 200-day moving average, and that average itself starts sloping upward. This helps separate a true advancing market from a temporary bounce inside a larger decline. If the chart keeps recovering from pullbacks and then pushes to fresh highs, that is the visual signature of a bull trend. Not every bull market is powered by the same engine, and that difference matters. Some advances are driven by rising earnings and stronger profits, which usually makes them more durable because businesses are genuinely improving. Others are helped by better economic conditions where consumers spend more, companies invest, and growth expectations rise. Lower interest rates or easier monetary policy can also support asset prices by making borrowing cheaper and pushing investors toward riskier assets. But some rallies are led mostly by excitement, hot sectors, or speculation, and those can move fast while also being more fragile. Understanding what is driving the advance helps you judge whether you are looking at a solid trend or a story that may fade quickly. Price tells you where the market is going, but volume and momentum can tell you how convincing that move really is. When up days come with stronger volume, it often means buyers have real conviction behind the advance. If down days happen on lighter volume, that is usually a healthier sign because selling pressure is less aggressive. On the other hand, a rally that drifts higher on weak participation can be vulnerable if enthusiasm starts to fade. Momentum indicators like RSI can help too, but they need context. In a strong bull market, RSI can stay overbought for longer than many beginners expect, so overbought does not automatically mean sell. Bull markets often reward patience more than urgency. A disciplined entry usually starts with confirming that the larger trend is already up, rather than guessing that an uptrend is about to begin. Once that bigger picture is in place, pullbacks tend to offer better opportunities than chasing a sharp breakout after everyone is already excited. Many traders watch areas near the 50-day or 100-day moving average because those zones can act like support during a healthy trend. Buying closer to support also gives you a clearer place to define risk if the trade fails. That simple habit can improve decision quality more than trying to catch every fast-moving surge. Strong markets make it easy to believe every position should be held forever, and that is where discipline often slips. A better approach is to decide in advance how you will take profits before emotions have a chance to interfere. For example, you might trim part of a position after a meaningful gain, then let the rest continue if the trend stays healthy. That way you lock in some progress without fully stepping aside from a strong market. A stop or trailing stop can help protect gains if the trend weakens later. The main idea is simple. A good exit plan keeps greed from replacing judgment. QQ in 2023 is a useful real-world example of a bull market in action. Over the year, it rose from roughly $280 to about $405, which was a gain of more than 44%. More important than the number itself was the character of the move. The weekly chart showed a persistent pattern of higher highs and higher lows. There were pullbacks along the way, but they stayed inside the broader uptrend instead of breaking it. That is exactly the kind of behavior disciplined investors look for, because it creates opportunities to enter during pauses rather than after every surge. The lesson from a year like that is not to chase strength blindly, but to recognize when an orderly trend is staying intact. Rising markets can hide bad habits because many mistakes still make money for a while. One common error is buying into parabolic moves, where price has already become stretched and risk is much larger than it looks. Another is mistaking a short-lived bear market rally for a fresh bull market before the bigger downtrend has truly changed. Investors also get into trouble by ignoring weak volume under the advance, because a move without strong participation may not be as healthy as the chart first suggests. After a streak of wins, overtrading becomes another danger, since confidence can quietly turn into carelessness. And perhaps the most costly mistake is staying in a position with no clear risk plan simply because the market has been rewarding that behavior. One of the best ways to get better at reading bull markets is to practice with a simple, repeatable chart routine. Mark each pullback that comes back toward the 50-day moving average and see whether buyers stepped in there. Then look for the next higher high after the rebound, because that helps confirm the trend is still healthy. Measure how far price traveled from the pullback area to the next peak, so you start seeing what a typical move looks like. Check volume on the rebounds too, since stronger participation can add confidence to the setup. Finally, ask where partial profit taking would have made sense, so you build the habit of planning both the entry and the exit. Section 2. Bear markets. A bear market is more than a routine setback or a few rough weeks. It is a sustained decline, often marked by prices falling 20% or more from a recent high, but the deeper meaning is that conditions and sentiment have genuinely worsened. Unlike a normal pullback, a bear market usually lasts for months or longer and reflects broader pressures rather than temporary weakness. Investors become more defensive, economic concerns become more important, and risk starts to matter more than optimism. The market may still bounce from time to time, but the larger direction remains under pressure. So the key distinction is persistence. A bear market is a lasting negative trend, not just a bad stretch inside an otherwise healthy one. Bear markets often become self-reinforcing, which is part of what makes them so difficult emotionally. Falling prices create losses, and those losses can trigger margin calls or force investors to sell positions they might otherwise have held. That additional selling pushes prices even lower, which then damages confidence further and makes buyers more hesitant to step in. At the same time, weak economic data or disappointing earnings can keep adding new reasons to sell. The result is a feedback loop where less buying and more forced selling feed on each other. Understanding that cycle helps explain why bear markets can continue longer than many people initially expect. Supportive policy can help eventually, but it often does not stop a bear market right away. Central banks may cut rates, governments may announce stimulus, or liquidity may improve. Yet investors still want proof that conditions are actually getting better. Markets often continue falling after policy action begins because confidence has already been damaged. People become slower to trust good news, especially after several failed rebounds. Sentiment usually heals more gradually than headlines suggest. So policy support matters, but in real time, the market often needs evidence, not just promises. One of the hardest parts of a bear market is that rebounds can look very convincing. Sharp rallies often appear in downtrends, and they can attract buyers back in by making the market seem healthy again. But if the larger pattern is still lower highs and lower lows, many of those rallies fade quickly. That is why context matters more than excitement. A bounce inside a weak market is not the same thing as a true trend reversal. Treating every rebound as a new bull market is one of the most expensive mistakes investors make during long declines. Bear markets often pass through recognizable phases, even though no two look exactly the same. Early on, denial is common where the first drop is dismissed as temporary, and investors expect a quick recovery. As losses deepen, fear begins to replace confidence and people start paying closer attention to downside risk. Capitulation comes later, when panic selling peaks and many investors simply want out at almost any price. After that, stabilization can begin, with selling pressure easing even if confidence has not fully returned. This framework is useful because it helps you understand behavior, but it should not be treated like a precise timing tool. A bear market usually develops through a sequence that gives clues about increasing risk. There is often an initial trigger, such as inflation pressure, recession concerns, a policy shock, or financial stress. Then selling volume starts to expand, which tells you the decline is attracting broader participation. Important support levels begin to fail, and that technical damage often changes how investors think about the market. As weakness spreads from one area into many sectors, the problem becomes harder to dismiss as isolated. By that stage, the trend is no longer just soft. It is becoming structurally weaker. Later in a bear market, stabilization can start to appear, though that does not guarantee a final bottom is in place. Price action often becomes less chaotic, with smaller swings and fewer disorderly drops. Volume patterns may also start to settle, suggesting that forced selling is losing intensity. Sentiment can remain extremely pessimistic during this phase, which is why stabilization often feels uncomfortable rather than reassuring. Long-term investors sometimes begin accumulating gradually here, not because risk has vanished, but because panic is no longer accelerating. The key idea is that a market can stop acting violently before it is ready to trend higher. The 2022 decline in the S&P 500 is a clear modern example of how a bear market can unfold. The market peaked in January, and a rebound into March looked encouraging enough to tempt people into thinking the worst might be over. But inflation stayed persistent. The Federal Reserve kept tightening aggressively, and the broader pressure on risk assets did not go away. As those forces continued, the market resumed falling. By June, the decline had moved beyond 20% from the high, putting it into bear market territory by the common definition. It was a strong reminder that temporary rallies do not cancel a larger downtrend when the main pressures are still in place. Exit rules matter most when markets are weak, because they can prevent a difficult period from becoming a catastrophic one. Without a plan, investors often hold through large drawdowns and then need enormous gains just to recover. A trailing stop or another predefined exit rule can limit damage while the decline is still manageable. Preserving capital is not just about avoiding pain, it also creates future options. Cash gives you flexibility to re-enter later, diversify differently, or simply wait for better conditions. In bear markets, protecting capital is often the decision that gives you the most power later. Long sell-offs tend to punish impatience and reward discipline. Buying the dip too early is a common problem, especially when investors assume every sharp drop should bounce the way it might in a bull market. Ignoring weak volume on rallies is another mistake, because many rebounds fail when participation is poor. Holding and hoping can quietly turn a manageable loss into a major drawdown, and using leverage to average down only increases the danger. Constantly reacting to headlines can make things worse by creating emotional, low-quality decisions. In a prolonged bear market, the better playbook is usually simpler. Control risk, reduce size, and wait for clearer evidence. Section 3. Sideways markets. A sideways market is a period when price stops trending clearly and begins moving back and forth inside a horizontal range. Instead of building a lasting uptrend or downtrend, the market oscillates between support on the bottom and resistance on the top. That pattern tells you neither buyers nor sellers have enough control to push price decisively in one direction. These ranges can last for just a few days, but they can also continue for weeks or even months. Very often they appear after a strong prior move when the market pauses to digest gains or losses. The key feature is balance. Price keeps reversing within the same zone rather than escaping it. When the market shifts from trending to sideways, your trading logic needs to shift with it. Trend following methods work best when price keeps moving in one direction, but ranges behave differently. In a sideways market, price often drifts back toward the middle or the opposite edge instead of continuing to run. That means momentum signals become less reliable and mean reversion becomes more important. The best setups are usually found near support or resistance, where you have clearer levels and better reward relative to risk. Trades placed in the middle of the range are often lower quality because there is less edge and less room before price can reverse again. Sideways markets can look calm, but they often hide a different kind of difficulty. False breakouts are common, where price briefly pushes beyond support or resistance and then quickly snaps back into the range. Liquidity can also be inconsistent, which makes moves feel uneven and sometimes harder to trade than they appear. Quiet trading does not always stay quiet either, because low volatility periods can suddenly give way to sharp bursts of movement. That combination can frustrate traders who assume a calm chart means easy decisions. In these environments, risk control often matters even more than in a clean trend. Identifying a trading range starts with marking clear horizontal boundaries. A practical way to do that is to look for at least 2 swing lows that hold around the same area for support, and at least 2 swing highs near the same area for resistance. Once price keeps respecting those levels, you can reasonably treat the market as range-bound. It usually makes sense to stay with that assumption until there is a decisive close outside the range, rather than reacting to every brief poke above or below it. Volume often fades as a range matures, which reflects declining urgency from both sides. That quieting behavior can be a useful clue that the market is coiling, even if the eventual breakout direction is still unknown. A practical range trading plan is built around location. Traders usually want to buy near support or sell near resistance, because those entries offer more upside or downside potential relative to the amount at risk. The center of the range is usually the least attractive place to act, since price can reverse in either direction without much warning. Indicators like RSI or stochastic can help with confirmation, especially if they show oversold conditions near support or overbought conditions near resistance. But those tools work best as supporting evidence, not as standalone signals. Stops are typically placed just outside the range, because a decisive break beyond the boundary means the original idea may no longer be valid. In a range, the goal is usually not to capture every last cent from one edge to the other. Many traders target roughly 60 to 80% of the range width because waiting for a perfect touch of support or resistance can lead to missed exits. If a stock is moving between $48 and $52, the full range is $4, but a practical target might be smaller than that. This keeps the plan realistic and less dependent on perfect timing. At the same time, you want to stay alert for clues that the range is ending. A clear close outside the boundary, especially with above-average volume, gives a breakout much more credibility than a brief intraday spike that quickly fades. Consider a stock trading between $48 and $52 for about 6 weeks. Volume has been fading, RSI has been swinging back and forth, and the repeated reversals suggest the range is mature. A trader using range logic might look to short near resistance at around 51.80 with the stop just above the range at 52.20. The initial target could be near 48.80, which aims to capture most of the move without demanding a perfect touch of support. As price moves lower, the trader might scale out part of the position, take some profit, and tighten risk on the rest. This is a good example of how a simple range setup can become a structured trade with defined entry, stop, and management rules. A range trade only works as long as the range continues to hold. If price closes clearly beyond resistance, especially on stronger than usual volume, the original mean reversion thesis is no longer valid. At that point, the right response is usually to exit the trade and accept the small planned loss. That is not failure. It is disciplined execution. The market has simply changed from a range environment to something that may require trend logic instead. Traders get into trouble when they keep arguing with the chart after the evidence has shifted. Protecting capital starts with accepting when the idea is no longer true. Most mistakes in sideways markets come from poor location or poor adaptation. Trading in the middle of the range is a common problem, because the reward is limited and the direction is less clear. Another mistake is trusting breakouts that happen on weak volume. Since many of them fail and trap traders, holding on to a range trade after a real breakout is just as costly, because the environment has changed and the old thesis no longer fits. One of the best ways to improve is to practice marking support, resistance, entry, stop, and target directly on charts. That exercise teaches you to think in terms of structure and planning rather than impulse. Section 4. Crashes. A market crash is different from an ordinary decline because of both speed and severity. In a normal correction, prices may fall meaningfully, but usually over a longer period, which gives investors more time to process what is happening. In a crash, prices can drop 20% or more in a very short window, sometimes in just days or weeks. That compression in time changes behavior because decisions have to be made under much greater pressure. Broad parts of the market tend to fall together, and trading conditions can become disorderly. So the defining feature of a crash is not just that it is deep, but that it is deep and fast at the same time. Crashes become especially dangerous because normal market function can start to break down. Prices may gap lower suddenly, which means they skip over levels where people expected they could react. Fear can overwhelm analysis, so valuation and careful reasoning matter less in the short run than urgent selling pressure. Forced selling adds to the problem, especially from leverage, risk models, or investors who simply need cash. At the same time, buyers may disappear temporarily, making even good assets hard to sell at reasonable prices. In that environment, execution gets worse and decisions become more costly. Most crashes begin with a trigger, but the trigger alone usually does not explain the full damage. The initial shock might be an unexpected event, a major policy shift, a financial accident, or the bursting of an overvalued bubble. What turns that shock into a crash is often market fragility that was already there beneath the surface. If investors are heavily leveraged, sentiment is stretched, or liquidity is thin, a surprise can quickly turn into a cascade. In a more resilient market, the same shock might produce only a moderate dip. So the real lesson is that triggers start the move, but fragility amplifies it. Two forces often make crashes worse than ordinary sell-offs: leverage and poor liquidity. When investors borrow money, even a moderate drop can trigger margin calls that force them to sell into weakness. That selling pushes prices lower, which can trigger more margin calls and more selling in a painful chain reaction. At the same time, liquidity can dry up, meaning there are fewer willing buyers at each price level. When that happens, exits occur at much worse prices than investors expected. This is why crashes often feel less like a smooth decline and more like the floor suddenly disappearing beneath the market. It helps to separate three terms that people often use interchangeably. A correction is usually a decline of 10% or more that unfolds over time, often over weeks or months. A crash is deeper and much faster, compressed into a short period where fear and disorder dominate. A bear market, by contrast, is a broader and more prolonged downturn that can last many months. Sometimes a crash becomes the opening stage of a bear market, but not always. In real time, that distinction is difficult because investors do not know immediately whether a sudden plunge will stay temporary or become something much larger. Because crashes move quickly, preparation matters much more than prediction. A practical response process starts by watching for fragile conditions such as rising volatility, weakening breadth, or signs of stress beneath the surface. The next step is to set clear rules in advance so you are not inventing decisions in the middle of chaos. If those rules are triggered, risk needs to be cut quickly rather than negotiated with. After conditions improve, re-entry is usually better done in stages instead of all at once. This kind of process does not eliminate losses entirely, but it can prevent panic from becoming the main decision maker. During a fast decline, the most helpful actions are usually calm and mechanical. Pre-planned price or volatility triggers can tell you when to reduce exposure without relying on emotion in the moment. If you need to trim positions, it often makes sense to reduce high beta or speculative holdings first because they tend to suffer the most in disorderly markets. Keeping leverage out of the portfolio is especially important, since borrowed money can turn a bad decline into a forced liquidation. It is also wise to wait for selling pressure to stabilize before trying to rebuild risk. The goal is not to call the exact bottom, but to avoid unnecessary damage while conditions are abnormal. Some reactions feel bold during a crash, but usually make things worse. Averaging down in a free fall can rapidly increase losses before there is any evidence that selling has finished. Ignoring widening spreads and fading liquidity is another danger, because a quoted price may not reflect the price you can actually trade. Buying protection after volatility has already surged can also be expensive, since hedges often cost the most when fear is already extreme. Constant trading without a clear plan creates noise, fees, and emotional exhaustion. Under crash conditions, simplicity and discipline are usually much safer than activity for its own sake. A rules-based response during 2020 shows what preparation can look like in practice. Imagine an investor beginning with a balanced portfolio of 50% equities and 50% cash. After a severe one-day decline of 3%, that investor follows a pre-written rule and cuts equity exposure to 30% instead of waiting and hoping. They avoid margin, avoid leveraged exchange-traded funds, and stop making fresh buys while conditions remain unstable. Once the market begins to stabilize, they re-enter gradually with smaller size rather than rushing back in all at once. The strength of that approach is not that it predicts every turn, but that it limits emotional damage and preserves flexibility. A personal crash plan should be specific enough that you could actually follow it under stress. Start with your largest current position because that is often where risk matters most. Then choose several one-day breach levels such as large percentage declines, and assign a clear action to each one. For example, a first threshold might trigger a 25% reduction, a deeper drop might trigger a 50% cut, and an extreme move might mean a full exit. The point is to write rules that are mechanical and observable. Vague language like "if the news looks bad" usually fails because stress makes judgment less reliable, not more. Section 5. Trade walkthroughs. A trade walkthrough turns a market idea into a sequence of decisions you can actually follow. Instead of thinking only about direction, it forces you to define the setup, the entry, the stop, the position size, and the target before money is at risk. It also asks what you will do if conditions change, which is often where unplanned trades fall apart. That structure reduces emotion because fewer choices are left for the heat of the moment. In other words, a walkthrough is not just about finding a trade. It is about making execution more deliberate and less impulsive. Before placing any trade, 5 questions can anchor the whole plan. First, why is this setup valid right now rather than yesterday or tomorrow? Second, how much are you willing to lose if the idea fails? Third, where exactly are you out if you are wrong, based on the chart rather than on hope? Fourth, what target makes sense if the trade works, and is the reward large enough relative to the risk? And fifth, what will you do if conditions change, such as a failed breakout, a volatility spike, or weakening volume? If a trade cannot answer those questions clearly, it usually is not ready to be placed. Strong trade planning follows the same order every time, so important steps do not get skipped. You begin by identifying a clear setup, such as a pullback in an uptrend or a breakout from a range. Then you define the exact trigger that tells you the setup is actually activating. After that, position size is calculated from the amount you are willing to risk, not from excitement or conviction. Only then do you set the stop loss and profit target. Once the trade is live, the job becomes execution, monitoring, and review rather than constant reinvention. 2 habits matter early in any trade plan: wait for confirmation and size from risk. Entering on anticipation alone can feel clever, but it often means you are buying before the market has actually proven your idea. A clear trigger level solves that problem by telling you exactly what has to happen before you act. On the risk side, start with the maximum dollar amount you are willing to lose on the trade. Then divide that by the risk per share, which is the distance from entry to stop, to get your position size. Rounding down helps keep the trade safely inside your limits instead of stretching them. Exits work best when they come from chart structure rather than arbitrary numbers. A stop should usually sit at the point where the setup is no longer valid, such as below support, below a swing low, or beyond another meaningful market level. A target should also be realistic, often near the next area of resistance or a logical price objective. This keeps the plan tied to how the market actually behaves, rather than to personal preferences. It also allows you to judge reward relative to risk before entering. If the setup does not offer at least a reasonable reward to risk ratio, often around 2 to 1 or better, it may not be worth taking. Consider a breakout setup in a stock called XYZ that has been moving sideways between $45 and $52. Resistance is forming near $50, and then price breaks above that level on volume that is 40% above average. That added volume matters because it suggests the breakout has more participation behind it. A trader might place a buy stop at $50.10, so the trade only activates if strength continues. The stop loss could go at $49.20 beneath the breakout area, and the target might be $53. This gives you a complete plan tied directly to the chart rather than a vague bullish opinion. Once the chart levels are set, the risk math becomes straightforward. Suppose the account is $10,000 and the trader risks 1% on any single trade, which means the maximum loss is $100. If entry is $50.10 and the stop is $49.20, then the risk per share is 90 cents. Dividing $100 by 90 cents gives about 111 shares, but a disciplined trader rounds down to 100 shares to stay within limits. At that size, the total risk is about $90. If the target is $53, the reward is about $2.90 per share, creating a reward to risk ratio of roughly 3.2 to 1. Imagine the order fills at $50.10 and the trade begins working. Price climbs to 52.80, then pulls back to 51.40 before moving higher again. That pullback can feel uncomfortable, but discomfort alone is not a reason to change the plan. If nothing on the chart has invalidated the setup, the stop stays at 49.20 and the target stays at $53. Eventually, price reaches the target, and with 100 shares, the trade produces about a $290 gain. The lesson is that normal volatility inside a valid setup should not automatically trigger emotional changes. Many trading mistakes happen after the plan has already been written. Entering before confirmation is one of the most common, because impatience makes traders act before the trigger is actually hit. Ignoring volume on a breakout is another problem, since weak participation often lowers the quality of the move. Oversizing the position can turn a normal losing trade into an emotionally disruptive one. Moving the stop farther away after entry changes the original risk without a valid new reason. And skipping the trade log removes the feedback loop that helps you improve over time. One of the safest ways to build trading skill is to practice the full process without placing a live trade. Pick a stock that is moving in a clear sideways range and mark support and resistance. Then write out the trigger, stop, position size, and target exactly as if you were going to trade it. Watch what happens over the next 5 trading days without entering anything. Afterward, compare your plan with the actual market behavior and ask what held up and what you would change. This kind of observation practice develops planning skill and discipline before real money is involved.